Hey learners, welcome back to Edu Intern Voyage. Your learning journey starts. If you are a BCom student who wants simple, clear, and reliable study content, subscribe to Edu Intern Voyage, like the videos, and start your learning journey today.
Different types of leasing help firms choose the most suitable method based on risk, cost, duration, and control over assets. Unit -4. 1. Define credit rating. According to John Moody, credit rating is an opinion regarding the ability of a borrower to repay debt obligations in time. 2. What is CRISIL? CRISIL, Credit Rating Information Services of India Limited, is India's first credit rating agency that evaluates the creditworthiness of companies and financial instruments. 3. What is ICRA? ICRA, Investment Information and Credit Rating Agency, provides credit ratings and financial research services to help investors make decisions. 4. What is CARE Ratings? CARE, Credit Analysis and Research Limited, is a credit rating agency that assesses the risk and reliability of debt instruments and companies. 5. What is factoring? Factoring is a financial service where a business sells its accounts receivable to a factor to get immediate cash. 6. What is forfeiting? Forfeiting is a financial service in which an exporter sells its long-term receivables to a forfeiter to receive immediate cash without risk. 7. What is bills discounting? Bills discounting is a process where a bill of exchange is sold to a bank at a discount before maturity to obtain immediate funds. Functions of credit rating. Introduction. Credit rating is the evaluation of the creditworthiness of a borrower or financial instrument. It helps investors understand the risk involved in investment decisions. In India, agencies like CRISIL, ICRA, and CARE Ratings perform this function. Functions of credit rating. 1. Assessment of credit risk. Evaluates the ability of issuer to repay principal and interest. Indicates the level of risk involved. 2. Helps investors in decision-making. Provides clear information about safety of investment. Helps investors choose suitable securities. 3. Facilitates easy fundraising. Highly rated companies can raise funds easily. Improves confidence of investors. 4. Promotes transparency. Provides reliable and unbiased information. Reduces information asymmetry. 5. Saves time and cost. Investors need not conduct detailed analysis. Reduces research efforts. 6. Improves market efficiency. Helps in proper pricing of securities. Ensures smooth functioning of capital market. 7. Encourages financial discipline. Companies maintain good financial performance to get better ratings. 8. Protects investors. Warns investors about risky investments. Reduces chances of financial loss. 9. Facilitates regulatory compliance. Required for issuing certain financial instruments. Helps in following regulatory norms. 10. Aids in portfolio management. Helps investors diversify based on risk levels. Assists in selecting safe and profitable investments. Conclusion. Credit rating plays a crucial role in the financial system by providing risk assessment, transparency, and investor protection. It helps in the efficient allocation of funds and development of capital markets. Debt rating is the evaluation of CRISIL, ICRA, and CARE. Introduction. Debt rating is the evaluation of the creditworthiness of debt instruments like debentures and bonds. In India, major agencies such as CRISIL, ICRA, and CARE Ratings provide these ratings to indicate the level of risk and safety. White heavy checkmark I CRISIL Debt Rating System. Rating. Meaning. AAA. Highest safety, lowest risk. AA. High safety. A. Adequate safety. BBB. Moderate safety. BB. Moderate risk. B. High risk. C. Very high risk. D. Default. Backhand index pointing right example, a company with AAA rating is highly reliable for repayment. White heavy checkmark 2. ICRA Debt Rating System. Rating. Meaning. AAA. Highest safety. AA. High safety. A. Adequate safety. BAA. Moderate safety. BA. Moderate risk. B. High risk. C. Very high risk. D. Default. Backhand index pointing right uses similar structure but with slight variation in symbols. White heavy checkmark 3. CARE Debt Rating System. Rating. Meaning. CARE AAA. Highest safety. CARE AA. High safety. CARE A. Adequate safety. CARE BBB. Moderate safety. CARE BB. Moderate risk. CARE B. High risk. CARE C. Very high risk. CARE D. Default. Backhand index pointing right prefix care is added to indicate agency. White heavy check mark key points of debt rating system. Ratings show ability to repay debt. Higher rating equals lower risk. Lower rating equals higher risk. Helps investors make decisions. 2 Significance of debt rating. 1 Helps investors in decision making. Provides clear idea about risk level. Helps choose safe investments. 2 Measures credit risk. Indicates the ability of issuer to repay debt. 3 Facilitates easy fundraising. Highly rated companies attract more investors. 4 Promotes transparency. Provides reliable and unbiased information. 5 Saves time and cost. Reduces need for detailed analysis by investors. 6 Encourages financial discipline. Companies try to maintain good ratings. 7 Improves market efficiency. Helps in proper pricing of securities. 8 Protects investors. Warns against risky investments. Explain the types of factoring arrangements in India. Introduction. Factoring is a financial service in which a business sells its accounts receivable, book debts, to a financial institution called a factor for immediate cash. It helps firms improve liquidity and working capital management. Types of factoring arrangements in India. 1 Recourse factoring. The client, seller, bears the risk of bad debts. If the debtor fails to pay, the client must compensate the factor. Lower cost compared to non-recourse factoring. 2 Non-recourse factoring. The factor bears the risk of non-payment by the debtor. Provides credit risk protection to the client. Higher service charges due to risk taken by factor. 3 Advance factoring. Factor provides immediate advance, usually 70 to 90% of invoice value. Balance is paid after collection from debtors. Helps improve liquidity quickly. 4 Maturity factoring. No advance payment is given. Factor pays the client only on maturity date or after collection. Mainly used for collection and credit services. 5 Full service factoring. Factor provides complete services such as financing, sales ledger management, collection of debts, credit protection. 6 Bulk factoring. Only financing is provided. Sales ledger management remains with the client. Lower cost compared to full service factoring. 7 Domestic factoring. Buyer and seller are located within the same country. Common in Indian business transactions. 8 International factoring. Used in export-import transactions. Involves export factor and import factor. Helps in reducing risks in foreign trade. 9 Undisclosed, confidential, factoring. Debtors are not informed about factoring arrangement. Client collects payments and pays the factor. 10 Invoice discounting, quasi-factoring. Factor provides finance against invoices. No additional services like collection or ledger management. Conclusion. Factoring arrangements in India offer various options to businesses depending on their needs for finance, risk protection, and collection services. It improves cash flow, reduces credit risk, and supports smooth business operations. Comparison, factoring, forfeiting, and bill discounting. Introduction. Factoring, forfeiting, and bill discounting are financial services that help businesses obtain immediate cash by converting receivables into liquid funds. However, they differ in terms of nature, risk, period, and usage. Comparison table. Basis. Factoring. Forfeiting. Bill discounting. Meaning. Sale of short-term receivables to a factor. Sale of long-term export receivables to forfeitor. Discounting of bills of exchange before maturity. Nature. Continuous arrangement. One-time transaction. Occasional transaction. Period. Short-term. Medium to long-term. Short-term. Risk-bearing. May be with client, recourse, or factor, non-recourse. Always borne by forfeitor. Borne by seller if bill dishonored. Services. Finance plus collection plus advisory. Only finance. Only finance. Parties involved. Factor, client, debtor. Exporter, importer, forfeitor. Drawee, bank. Area of use. Domestic and export trade. Mainly export trade. Mostly domestic trade. Type of receivables. Book debts. Bills/promissory notes. Bills of exchange. Control over receivables. Factor manages collection. No control after sale. Bank does not manage collection. Cost. Higher, service plus finance. High due to risk. Lower compared to others. Factoring Regulation Act, 2011, Overview and Key Provisions. Introduction. The Factoring Regulation Act, 2011 was enacted to provide a legal framework for factoring services in India. It regulates the assignment of receivables and functioning of factoring companies, ensuring transparency and growth of the factoring industry. Overview of the Factoring Regulation Act, 2011. 1. Legal recognition to factoring. Gives formal legal status to factoring transactions in India. 2. Regulation of factoring business. Governs activities of factoring companies. Ensures proper functioning of the sector. 3. Assignment of receivables. Allows businesses to transfer receivables to factors legally. 4. Role of RBI. Factoring companies are regulated by the Reserve Bank of India. 5. Development of financial services. Encourages growth of factoring as a financing tool. 2. Key provisions of the Act. 1. Registration of factors. All factoring companies must be registered with RBI. Only registered entities can carry on factoring business. 2. Assignment of receivables. Receivables must be assigned through a written agreement. Ensures legal validity. 3. Notice to debtor. Debtor must be informed about assignment. Payment should be made to the factor. 4. Priority of charges. Factor gets priority over other creditors for assigned receivables. 5. Registration with CERSI. Assignment must be registered with Central Registry, CERSI. Prevents fraud and duplication. 6. Rights and obligations. Clearly defines rights and duties of factor, client, debtor. 7. Regulation and supervision. RBI monitors and controls factoring companies. 8. Transparency and disclosure. Ensures proper record keeping and disclosure. Conclusion. The Factoring Regulation Act, 2011 provides a strong legal base for factoring in India. It ensures regulation, transparency, and protection of all parties, thereby promoting the growth of the factoring industry. Unit 5.